Welcome back to this session for CMA Final students. This is your paper number 14 titled as Strategic Financial Management. In the last chapter, in the last video, better I will say, for revision of portfolio management, we studied that how to identify a minimum risk portfolio for a set of two securities portfolio. So we identified that there is a shortcut formula which is sigma 2 square is equal to sigma 1 square minus sigma 2 square. I'm sorry, it is sigma 2 square minus sigma 1 sigma 2 R12 divided by sigma 1 square plus sigma 2 square minus 2 sigma 1 sigma 2 R12. But even for this, we have to first make the calculation, identify the weights, apply those weights to check that whether there exists a portfolio which has a risk less than the risk of either securities taken alone, whether there exists a portfolio which has a risk less than the risk of either security taken alone. But there is even a further shortcut that without calculating W1, W2, and without applying the formula for risk of two securities portfolio, you can come to a conclusion that whether there exists a portfolio or not, which has the risk less than the risk of either security taken alone. And that super shortcut looks like this. If the correlation coefficient is less than sigma 1 upon sigma 2, here one thing you should keep in mind that sigma 1 must be less than sigma 2. Like in this example, two securities are there. One has the risk of 18%, while the other security has a risk of 15%. So in the numerator, you should take 15%, and in the denominator, you should take 18%. Obviously, there are two securities. So in the numerator, you should choose the security which has a lower standard deviation, and in the denominator, you should put the higher standard deviation. If this sigma 1 upon sigma 2, if it is greater than the correlation coefficient, if this test is satisfied, then it is possible to make a portfolio which has a standard deviation, which has a risk less than the risk of either security taken alone, which has a risk less than the risk of either security taken alone. So suppose in the previous example itself, the 15 and 18 were there. So now the question is minus 1 less than 0.83? And my answer is obviously yes. A negative figure is always lower than a positive figure. So the test is satisfied. So there exists a portfolio which has a low risk. And here it is the proof. The risk is even 0. Suppose the correlation is not minus 1. Let's take an example. Suppose correlation is plus 0.5. Let's assume. Even if the correlation is plus 0.5, the test is still satisfied that the correlation is less than sigma 1 upon sigma 2. That 0.5 is less than 0.83. And if this test is satisfied, I can surely say that there exists a portfolio which has a risk less than 15%. So that's a super shortcut. But keep in mind, this shortcut tells you only where there exists a portfolio or there doesn't exist a portfolio like this. But how much weight should be assigned and what exactly is the risk of that portfolio can be calculated like this only. And now there is a super duper shortcut. First we studied the shortcut. This one is the shortcut. Sir, if this is the shortcut, what was the proper method? This is the proper method. Make thousands of combinations and choose the best combination. This is the shortcut to identify the weight directly. This is the super shortcut that even you don't use any formula and simply apply the test, and at least you know in advance that should I try to make the portfolios or not. And now this is the super duper shortcut. If the correlation coefficient is negative, then this test will always be satisfied. Because if correlation coefficient is negative, a negative number is always less than the positive number. And if I'm saying a negative number is less than the positive number, and that is why the test will be satisfied and there exists a portfolio which has a lower risk. Okay. So now let's talk about three securities portfolio. How to calculate return on a three securities portfolio? It is again weighted average of individual returns. So return on portfolio is equal to R1 into W1 plus R2 into W2 plus R3 into W3. Here I am not dividing by total of weights because W1 plus W2 plus W3 is assumed to be 1. So don't say I am investing 30,000, 40,000 and 30,000 in security 1, 2 and 3 respectively. Rather than you say the weight is 0.3, 0.4 and 0.3. R1, R2, R3 are return on security 1, 2, 3 respectively. W1, W2, W3 are weight of security 1, 2 and 3 respectively in the portfolio. Now again, just like two securities portfolio, risk of the portfolio is not equal to weighted average of risk of individual securities. Rather than you need to consider correlation also. And now there will be three correlations. A correlation between security 1 and 2, a correlation between security 1 and 3, and a correlation between security 2 and 3. And that's why these three correlation combinations will be there and the formula will look very lengthy. Even if the formula is lengthy, but there exists a pattern in the formula, so it will be easy to memorize the formula. Sigma 1 W1 whole square plus sigma 2 W2 whole square plus sigma 3 W3 whole square divided by, plus 2 sigma 1 sigma 2 W1 W2 R12. This is 1 and 2 combination. Then 2 and 3, sigma 2, sigma 3, W2, W3, R23. And then 1 and 3 combination, sigma 1, sigma 3, W1, W3, R13. First you make a combination of 1 and 3, then you make a combination of 2 and 3, then you make a combination of 1 and 3. All three combinations are being made over here. So this is similar to, A plus B plus C whole square formula. This is similar to A plus B plus C whole square formula. And in this formula, the total of weights must be equal to 1. Let's do one question on this. Security D and E and F have the following characteristics with respect to expected return, standard deviation, and correlation between them. So return on DEF is like 8, 15 and 12%. And standard deviations, just a minute. Some alignment is disturbed, so I will quickly correct it for you. Just give me 1 minute. This is perfect. These three securities have return of 8, 15 and 12. They have a risk of 2%, 16% and 8%. And their correlation coefficients are like this. the correlation between D and E is 0.4, that is 1 and 2. Between D and F is 0.6, that is correlation between security 1 and security 3. And between E and F, it is 0.8. So it's a correlation coefficient between security 2 and security 3. So what is the expected return and standard deviation of portfolio? Composed of equal investment in each. So W1 is equal to W2 is equal to W3 is equal to 1 by 3. So guys, return on portfolio is quite simple. It's a weighted average of 8, 15 and 12%. 1/3 weight is assigned to each. And risk of the portfolio will look cumbersome like this. Sigma 1 W1 squared plus sigma 2 W2 square plus sigma 3 W3 square plus 2 sigma 1 sigma 2 W1 W2 R12 plus 2 sigma 1 sigma 3 W1 W3 R13 plus 2 sigma 2 sigma 3 W1 sigma 2 sigma 3 W2 W3 R23 like this, right? And then I do make a calculation for this. When I solve it, I'll get it 7.98%. You can do it in single shot on your calculator. I'll quickly tell you how to do it. 2 divided by 3 into m plus, 16 by 3 into m plus, into means multiply. 8 by 3 into m plus. Then this thing 2 into 2 into 16 divided by 3 into 4m plus. Don't do here into m plus. Here simply 0.4 and then m plus. Then 2 into 2 into 8 divided by 3 into 0.6 and then m plus. Same 2 into 16 into 8 divided by 3 into 0.8 m plus. MRC and under root. Do this and in one shot you'll get risk of a 3 securities portfolio. The risk of 2 securities portfolio itself was too complicated. So there is no shortcut as such for risk of a 3 securities portfolio. To calculate to identify a minimum risk portfolio for a 3 securities portfolio, there is only one way to make thousands and lakhs of combinations. Use Microsoft Excel in real life, not in examination. And thereafter, once you do it, choose the minimum risk portfolio. So this 3 securities portfolio risk is so complicated. What about the 4 securities? What about 100 securities? That will go with the same pattern, but it will become a very, very lengthy formula. So there can be, a super kind of shortcut. If you use this formula, you can calculate risk of the portfolio even for 100 securities. Sigma P is under root of beta square P into sigma M square into EP square. This formula is based on characteristic line, hence we will study it later. Now try to recall one thing, that this green one was the diagram for risk of a 2 securities portfolio. Taken risk on x-axis and return on y-axis. What if I do the same thing for n securities portfolio? When I make n securities portfolio, the combination will look like this. X-axis risk, y-axis return, and the diagram will look like this, an umbrella without a stick. So every single point in this area is a portfolio which comprises the combination of insecurity. This insecurities thing was discovered by Mr. Harry Markowitz, and that's why this is called the Harry Markowitz model, right? This is how you can continue to make up to n securities portfolio. Now, so this was one thing which we wanted to study and we studied it. Now, suppose finally, if I go back to the first chapter of portfolio management, I have divided for your convenience this portfolio management into several parts. So, look here. If you're an individual, you always need to make investment. When you make investment, either you can make your own investment or you can invest through mutual fund. When you make your own investment, you can invest either in equity or in debt. In equity, you can make the regular investment, which is the Harry Markowitz model, which we have already gone through. Now, how to make opportunity based investment? It means besides regular investment, if you find that any security is undervalued, something is available in the market at a very cheaper price, then go and buy it. When it is fairly priced, you can sell it and make extra money. Similarly, if a security which you own is overpriced, then you can simply sell it out because it is quite expensive. It has gone overvalued in the market. And again, when correction comes and the security falls down, you can buy it again. This is called opportunity based investment. And for that, we'll have to study capital asset pricing model and the market model. This is the whole context under which we are studying this chapter, so that at least you have an idea that where exactly are we in this progress of portfolio management. What is capital asset pricing model? See, this capital asset pricing model was created by Mr. William Shah. For this model and his several other contributions, Mr. William Shah got a Nobel Prize. So this model, you can say, is a kind of Nobel winning model. Capital asset pricing model says that look, when you make investments, especially in equity shares, you bear risk. What is risk? Risk means fluctuation. You buy shares worth rupees 1 lakh. After 1 year, it can rise up to 1,50,000, 2 lakh, 5 lakh, or it can get down to zero level also. That is the risk. Risk is the fluctuation in price of the share where you are making investment. This risk can be divided into two parts. One is the systematic risk and the other one is unsystematic risk. That is, the price of the share may fluctuate due to two reasons. Systematic risk means something which affects entire share market, hence it is also affecting your share. That is named as systematic risk. Now, for example, the COVID-19 situation, it was a pandemic, and in March 2020 or in January, February 2020, when this pandemic started, then in March and especially in April 2020, the stock market crashed. It nosedived. It reduced drastically. So every single security in the market was falling down. Hence, your share was also falling down. This is called systematic risk. On the other hand, what is unsystematic risk? Which affects your company only. Suppose workers in your company declares a strike or a new competitor enters into a market. And it is not always the bad news, whether it is systematic or unsystematic risk. It may be a good news, it may be a bad news, it may result in fall in share price, it may result in rise in share price. Suppose you entered into a foreign collaboration, which is very positive for you. This is just for you, not for entire market. A fraud is detected in the company, custom duty uh, is increased on the imported raw material. So this is going to affect you only and not to the entire market. This is called unsystematic risk. So total risk is the sum total of systematic plus unsystematic risk. Now CAPM says that unsystematic risk can be reduced or even it can be eliminated. See, how come this that unsystematic risk can be reduced or eliminated? If I invest in a single security, I'm bearing market related risk as well as company related risk. But if I make a portfolio, I invest in 30, 40, 50 shares. Out of 50 shares in this month, if 15 shares are having individual bad news, hence they are falling, but other 20 shares are having individual good news and they are rising. So they kind of will cancel out each other, and I'll be left with only systematic risk. That is, if the entire market is falling, then my portfolio will fall down, and if entire market is rising, my portfolio will also rise. So what does it say? There is a saying in English, not keeping all the eggs in the same basket. So not keeping all the money in the same stock. You need to diversify your portfolio. If you start diversifying your portfolio, then what happens is your unsystematic risk reduces. If I take number of securities in my portfolio on x-axis and standard deviation of portfolio on y-axis, then this red line is standard deviation on portfolio. With increase in number of securities in my portfolio, I don't invest in one share, rather than I invest in 2, 3, 5, 10 shares. Initially, the total risk reduces rapidly, and thereafter it reduces slowly. So this app, from top to bottom, this indicates total risk. Notice that even if you include many securities in your portfolio, still your portfolio risk does not fall below this level. So I can say that this is the bare minimum risk I'll have to take, and this is actually the systematic risk. This is actually the systematic risk. And over and above this one is the unsystematic risk. And see, by increasing various types of securities in your portfolio, this unsystematic risk can be reduced or even eliminated. That is the submission of CAPM, that why are you bearing unsystematic risk? You can simply eliminate, you can simply reduce unsystematic risk by making a diversified portfolio. So this is what CAPM says, and it says that as the unsystematic risk can be eliminated, therefore market will never give you any risk premium for taking unsystematic risk. It will give you risk premium only for taking systematic risk. Actually, CAPM teaches an investor the manners of expecting return. If you invest in equity shares of a company, and if somebody asks you what is your expected rate of return, you can say I want 100% per annum. But that will sound too greedy, right? So you need to be rational. Your expectation of return should be reasonable. Anywhere in your life, if you expect too much, you will lose the opportunity. You go for a job interview and the interviewer asks, what salary package do you expect? And you say 5 crore rupees per annum. You lose the job as a fresh chartered accountant, as a fresh company secretary, as a fresh cost accountant, as a newly qualified MBA. You lose the job opportunity. And if you expect too less, I am ready for 2000 rupees per month, then you will get that only. If you expect too much, you'll get nothing. If you expect too less, you'll get too less. So you should expect reasonable and get reasonable. Now, how to calculate reasonable expectation of investor is given by CAPM. It says ERP, that is the ideal expectation of return of the investor. So why E? E for expected. What is RP? Return on portfolio. It may be a single security portfolio, two securities portfolio, three securities portfolio, or even n securities portfolio. ERP stands for expected return on portfolio, right? So expected return on portfolio is equal to minimum RF, minimum risk-free rate of return. If the promoter of a company say, okay, come on, everybody come here and buy shares in our company. And in this share, you will be able to earn 3% per annum. You will say, even FD is giving me 6% per annum. Why should I buy a share at 3% per annum? You will not make any investment if the rate of return is less than the rate of FD. I say, okay, invest in my business and you will earn 2% per annum. You will say, rather than investing in business, I'll make FD in State Bank of India. So, as an investor, your basic minimum expectation is always equal to the risk-free rate of return. Your basic minimum expectation is always equal to the risk-free rate of return, right? But you can't say that from investment in equity share, I want 6% FD return. No, no, no. You're taking a risk. So besides risk-free return, State Bank of India FD or Government of India bonds are risk-free. You don't take any risk. Your money is secure. And that's why the rate of return on those securities is named as risk-free rate of return. So what do you do? That to calculate risk premium, that how much risk premium will you charge? The formula says you take RM minus RF into beta. Now RF is clear, it is the risk-free return. RM is return on market portfolio, like return on Sensex or return on Nifty. And beta is the index of risk. That is how much risk you are taking. So let's take an example. Suppose risk-free rate of return is 7%. Just imaginary figures. I'm not saying that current rate is 7%. Only an example. So let's say, 7% is the risk-free rate of return. Sensex is providing on an average 12% return. What does it mean? Those who invest in Sensex, that is those 30 securities which are included in Sensex, they are getting 5% extra over and above the FD rate. Why are they getting 5% extra over and above the FD rate? And the answer is quite obvious. In FD, there is no risk, but in Sensex, a lot of risk is there. So this extra 5% is named as risk premium on market portfolio. Mind it, my dear students. RM is market return and RM minus RF is risk premium on market portfolio multiplied by beta, which is 1.5. Multiplied by beta, which is 1.5. What is 1.5? Actually, beta is not a measurement of risk. It is the index of risk. Suppose somebody asks you, what is your height? And you say, my height is 1.2. I say, is it 1.2 feet? You say, no, my height is 1.2 times as compared to your height. Or suppose you appear in a 400 marks examination and you scored 300 marks, let's say, and somebody asks you what was your score and you say 1.5. Oh, you scored only 1.5 marks? No, 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 no. My score is 1.5 times as compared to the passing score. The passing score was 200, my score was 300, so it's 1.5 times. Beta is not the measurement. 300 marks is the measurement of 1.5 is index of marks. So similarly, beta is not measurement of risk, it is the index of risk. If beta is 1.5, it means if market goes up by 10%, your security will go up by 15%. And if market comes down by 10%, your security will come down by 15%. So if beta is 1.5 times, it is simply 1.5 times risk. Now those who invest in Sensex, they are getting 5% risk premium. My risk is 1.5 times as compared to risk of Sensex. So I deserve a risk premium which is 1.5 times as compared to Sensex. So give me 7% as the risk-free rate of return, plus give me 7.5% for taking risk of buying this share. Only systematic risk. I'm asking risk premium only for systematic risk. I'm not asking risk premium for unsystematic risk, which is the company specific risk. Because I diversified my portfolio and the company specific risk or unsystematic risk is cancelled out. So ideally, my expectation should be 14.5%. Now try to recall one simple thing, that value is always equal to performance divided by expectation. If you perform good, your value in the market will rise. But if expectation of people rises beyond what you are performing, then your value in the market will come down. Want to increase your value? Either you should increase your performance or you should reduce expectation of people from you. Let's take an example. That a company is expected to give a dividend of rupees 5 per share forever. Equity share of a company is expected to give dividend of rupees 5 per share forever. So that's the performance of the company, that it is giving dividend of 5 rupees. Investors in this company, they want a rate of return of 10% on their investment. So the value per share will be rupees 50. Ideally. Now, if the actual expectation is less than the ideal expectation, suppose here I put 5%, then the value will be 100 rupees. Value is equal to performance upon expectation. If expectation is less, value will be more. So ideally expectation is 14.5. If actual expectation, see, whatever is the expectation of investor, it is his income. But for the company, it is the cost. So cost of equity, if it is 12%, then I will say expectation in the denominator is less. So value must be higher. And I'll say that the stock is overvalued and one who owns the stock should sell it. One who owns the stock should sell it. If actual expectation is more, instead of 14.5%, say it is 18%. If actual expectation is more, then expectation is in the denominator, and if it is more, then the value will come down. I'll say the share is undervalued and this is the opportunity to buy this share. This is how CAPM help us to identify overvalued and undervalued stock. First of all, you calculate expectation, which is the ideal one. So you calculate expectation with the formula, it is the ideal expectation. Compare it with the actual expectation. If actual expectation is less, share is overvalued, sell it out. If actual expectation is more, share is undervalued, buy it. And make extra money. This is not your regular investment return. This is the extra return you are getting due to undervaluation or overvaluation. And that's why I named this chapter as opportunity based investment. Okay, let's take an example. Risk free return is 6%, RF. Market return is 15%, this is RM. Calculate the required rate of return on stock, which has a beta of 1.5. Required rate of return on the stock, which has a beta of 1.5. Fantastic. RF is 6 plus RM minus RF is 15 minus 6 into 1.5 beta. And the answer is 19.5%. Ideally, investors should expect a 19.5% return on his investment. Let's make a graphical presentation of CAPM. If I take beta on x-axis, and ERP on y-axis, and calculate various values, then a straight line like this red line will be drawn. What do you observe in this straight line? First of all, when beta is 0 here, ERP is not 0. Look at this formula. Even if I put beta equal to 0, risk premium will become 0. But RF will still be there. So even if beta is 0, even if my risk is 0, still I will expect a return equal to risk-free return. Quite logical. Okay, so look at this. When beta is 0, still investor is expecting something, and that is the risk-free rate of return. And this line is upward sloping towards the right. Now what does that mean? With increase in beta, expectation of investor also rises. That's why it is upward sloping towards right. And if beta is equal to 1, then your expectation will be equal to market rate of return. Don't believe it? Look at this form. If I put here beta equal to 1, then multiplying by 1 doesn't make any difference. This RF and RF will be cancelled then, and I'll be left with RM. That's mathematically. Logically, if beta is equal to 1, it means my risk is same as the market risk. So I deserve a return same as the market return. If any secure, this straight line, this red line which you are seeing, is named as the security market line, SML. Yes, this is named as the securities market line or the SML. Now, any security which falls on SML, which lies on SML, is fairly priced because its expectation, every single point on SML indicates ideal expectation of an investor for a given beta. Every single point on SML indicates ideal expectation of investor for a given beta. If actual expectation is equal to ideal expectation, share is fairly priced. Look here, this security is on SML, so the share is fairly priced. Look here, this red dot, this is above SML. This is SML, this is above SML. What does it mean? That actual expectation is more than the ideal expectation. Ideal expectation is this straight line. Actual expectation is this red dot. Actual expectation is more than ideal expectation, and you already know that Value is equal to performance upon expectation. So if expectation is high, value is low. And that's why any security which is above SML is undervalued. And vice versa. Any security which is below SML is overvalued. Okay, let's do one question on this. Messrs X Limited has paid a dividend of rupees 2.5 per share. Okay, dividend of rupees 2.5 per share has paid D0 on a face value of rupees 10 in the financial year this and this. The further details are as follows. Current market price of the share is rupees 60. This is the actual market price. Growth rate of earning in dividend is 10%. Looks like you'll have to apply the Gordon's model. P0 is equal to D1 upon KE minus G. So D0 is here 2.5 and growth rate is 10%. For cost of equity, you'll have to use CAPM, RF plus RM minus RF into beta because that is expectation of investor and expectation is nothing but cost of equity. Beta is 0.75, market return RM is 15, risk-free return RF is 9. Calculate intrinsic value of the share and identify whether it is undervalued or overvalued. Look, this is very simple. First, you use the CAPM equation to calculate the ideal expectation of investor. That is the ideal cost of equity, which is RF plus RM minus RF into beta. 9 plus 15 minus 9 into beta of 0.75. So ideally expectation of investor should be 13.5%. Based on this, if I use the Gordon's model formula, P0 is equal to D1 upon KE minus G. So look, company has paid dividend as D0. Add 10% growth to it. So 2.5 plus 10% is 2.75. This will give you D1 divided by cost of equity. Ideally, it should be 13.5 minus growth rate, which is 10%. So fair value of this share, or I should say the ideal value of this share should be 78.75. While the actual price of this share is just 60. Now here you need not to think about value is equal to performance upon expectation. Here the value itself is given for comparison. Ideal value is 78 rupees. Actually it is available in the market only for 60 rupees. Ideal is 78.557. Actually in the market it is available at 60. And that's why this is undervalued. And for any undervalued security, your recommendation should be buy it. It is available at a cheaper rate. So don't miss the opportunity. Simply go and buy it. Or alternatively, you can also say, with the given data, you can also calculate cost of equity. In intermediate level, you must have studied that cost of equity is D1 upon P0 plus G. That's nothing but the reshuffled Gordon's model formula. D1 is 2.75, P0 is given as 60, actual P0 is 60, not the ideal one. Growth rate is 10%. So actual cost of equity is 14.58. Now ideal is 13.5. And if actual expectation is more, the value must be less. And that's why you should declare the share to be undervalued. Ideal expectation 13.5. Actual expectation 14.5. Actual expectation is higher. That is, the security is above SML. Higher the expectation, lower the value. So I can declare that this security is undervalued. But now there arises a question. How do we calculate this beta at all? Can we calculate it? Answer is yes. And beta is nothing but the regression coefficient which you have already studied in statistics somewhere. What is beta? It is nothing but the regression coefficient. And the process of calculating this regression coefficient or beta is actually named as the market model. What do you do in a market model? You take, either the return or the risk premium on Sensex on the x-axis. Here you take realized excess return on the market portfolio. So here you take return on Sensex, or risk premium on Sensex may also be taken, that's not a problem. And here you take return on your own security, your own portfolio. So what do you do then? You can do one thing. You can start observing the return on Sensex and return on your portfolio. For example, let's take this example. This is the month. This is Sensex. This is ABC Limited, your share. So in the month of January, any year, in the month of January, Sensex provided 2% return. ABC Limited provided 3% return. In the month of February, Sensex provided 5% return. ABC Limited provided 8% return. In the month of March, Sensex provided minus 1% return. ABC Limited provided minus 5% return. And so on. You keep on calculating this maybe for 12 months. Usually people take it for 5 years. That is 60 months. Just a long period of time. Okay. Now this one pair of data, 2% and 3%. When you draw a diagram, I'll tell you how. So you'll have to draw it like this. This is your y-axis and this is the x-axis. Give me one moment, please. And then here you will take Sensex. Here you will take Sensex. Here you will take ABC Limited. And this is like 1%, 2%, 3%, 4%. And here also this is 1%, 2%, 3%. So you move 2% on x-axis, 3% on y-axis, 2 here, 3 there, and this is just a single dot, right? So this one pair of data, just this one pair of data, 2 and 3%, is one dot. If you take 60 pairs of data, you'll have 60 dots. Once you have 60 dots, blue dots like this, then if somebody asks you to join all these points with one single straight line, you can't join them because they are not on a straight line. But definitely you can draw a trend line, a line of best fit, a regression line. You can draw it, a characteristic line, many names. One can set many names. Trend line, regression line, line of best fit, characteristic line. And then you measure the slope of this straight line. That this line is making 30-degree angle on x-axis. Then you calculate tan theta. If it is making 30-degree angle on x-axis, you calculate tan 30-degree. That will be beta. So if somebody asks you what is beta, you'll say beta is nothing but tan theta. Don't worry, you won't have to study trigonometry, sin theta, cos theta, tan theta. There are ready-made formulas for calculation of regression coefficient. You can calculate regression coefficient, that is beta, directly from the data, or from covariance, or from correlation. You can calculate beta using directly data, using covariance, using correlation. Many formulas exist. Okay, this was just to explain you the concept that what is beta. Beta is the slope of characteristic line. If the slope is 0, beta will be 0. If slope is 45 degree, beta will be 1. If slope is more than 45 degree, beta will be more than 1. Right? So what is beta? I have answered this. How do I calculate it? What is the formula? So my dear friend, this is the formula. I'll show it to you. So these are the various formulas for calculation of beta. If you directly want to calculate beta from the x and y series from data, it is n summation xy minus summation x into summation y upon n summation x square minus summation x whole square. It is easier than the correlation formula, isn't it? If you want to calculate beta from the given covariance, then beta is covariance between x and y divided by variance of x or square of standard deviation of x. You know, correlation between x and y and x is one and same thing. But beta of y on x and beta of x on y are two different things. We always calculate beta of y on x, that is beta of security with respect to beta of the market. That is, if market fluctuate, what will happen to security? We don't calculate if security fluctuate, what will happen to market. No, 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 no. If I pass, what will happen to rest of India? No, no. If result is very good, rest of the India is getting passed, then what happens to me? This is what I calculate. We always calculate beta of y on x. We always calculate beta of security share with respect to market. So with the help of covariance, how do you calculate beta? It is covariance of x and y divided by variance of x. How do you calculate covariance itself? X minus x bar into y minus y bar summation divided by n. How to calculate beta if correlation is given? You take correlation coefficient. In your study material, the correlation coefficient symbol is different. I have simply used R. They have used a symbol like rho, Latin word. Okay, so you take correlation multiplied by standard deviation of y upon standard deviation of x, and you can arrive at beta. These are various ways to calculate the beta, which is nothing but regression coefficient. Annual return on share of XYZ Limited and market return for last 6 years are given below. Evaluate the information and find out the equation of characteristic line. Equation of characteristic line is y is equal to alpha plus beta x, or you can say y is equal to mx plus c, or you can say y is equal to a plus bx, straight line equation. So we have to calculate not only beta but also alpha. 6 years return is given, return on share is given, which I will take on y-axis, and return on market portfolio is also given, which I will take on x-axis. Always take market on x-axis and your portfolio on y-axis. Then our usual calculation, you know, x, summation x, summation x square, summation y square, and summation of xy. How to do it quickly on your calculator, we have already discussed it a lot. Now, I can use this one, this formula, this one. N summation xy minus summation x into summation y, this one, okay? I'll use this formula and my calculation will look like this. Just a minute. Look at this. summation xy is 896. You can see here 896, and summation x into summation y here. In the denominator, summation of x square is 700 and summation x whole square is 54 square. Solve it and you'll get it equal to 1.16, right? Rest of the things, x bar and y bar, you can calculate. X bar is 54 by 6 is 9, y bar is 72 by 6 is 12. Now, what is the equation of the characteristic line, which is actually alpha plus beta? The y is equal to alpha plus beta x. That is the line of, that is the equation of straight line. How do I calculate alpha? So there is a formula, y bar minus beta into x bar. Y bar is 12, x bar is 9. So 12 minus 1.16 into 9. 12 minus 1.16 into 9. So it is plus 1.56. Alpha. What is alpha? Do you know? In this diagram, this intercept, the point where regression line is cutting y-axis, is alpha. And the slope is actually the beta. So characteristic line equation is 1.56 plus 1.16x. How do you use characteristic line? If you know x, you can find out y. If somebody gives you that, since x will rise by 10%, so you can easily calculate what will be rise in my share. Instead of calculating beta directly from the data, you can first calculate the correlation coefficient, and then you can use that correlation coefficient to calculate beta. That will also give you the same answer. Look here. Here, if I calculate beta as beta is equal to correlation, which is 0.70, multiplied by standard deviation of y, which is 9.88, divided by standard deviation of x, which is 5.97. Let's calculate it. It's 0.7 into 9.88 divided by 5.97. See, it is 1.158. That is 1.16. This is equal to 1.16. And here also it was 1.159. That is roughly 1.16. So both way, the answer is same. Now, look at this. I have this diagram, under various situations, how will it look like? They won't ask it in exam, but you will have a better grip on concept. This is positive beta. The upward sloping line is positive beta. If Sensex is rising, my share is also rising. This is zero beta. Even if Sensex rises or Sensex falls, my share remains constant. Probably it's not a share, it's a bond. It's a government bond. That's why it is constant irrespective of change in Sensex. Negative beta, downward sloping line. What does it mean? If market is rising, my share is falling. Negative beta. This is how positive, zero and negative beta looks like on the graph paper. If I talk about alpha, see, alpha is the intercept. Look at my cursor. This is positive alpha. And if this line cuts on the origin, that is 0 point, this is 0 alpha. And if the characteristic line cuts y-axis on the negative side, it is negative alpha. In these three examples, beta is positive because line is upward sloping. But alpha is positive, and then the alpha is 0, and then here the alpha is negative, right? Now, explained and unexplained variance, you don't know about it, so I'll better skip it. Maybe later at some other point we'll try to cover. Okay, so we'll continue in the next session. Till then, thank you. Bye bye.